$15,000. That's what I started with in my prop firm account. And in just 8 months, I turned it into over $100,000. But here's what nobody tells you about that journey. I blew up 3 accounts before this one. I lost money I couldn't afford to lose. I questioned everything about myself as a trader. And the strategy that finally worked? It wasn't some complicated algorithm or expensive indicator suite. It was mastering 2 simple concepts that have been hiding in plain sight on every single chart you've ever looked at. Before we dive in, smash that subscribe button right now and hit the bell icon, because what I'm about to share with you is the exact blueprint I used, the strategy, the psychology, and the mistakes that nearly destroyed me. Drop a comment below telling me where you're watching from and what time it is in your location. I want to know this community is global. And if you're serious about prop firm trading, check the description for my #1 recommended prop firm that actually pays out. Let me take you back to where this really started. It was 2:47 a.m., and I was staring at my trading screen with bloodshot eyes. I had just revenge traded my way through another losing streak, turning a manageable $800 loss into a catastrophic $4,200 drawdown. My hands were shaking. My heart was racing. And in that moment, I realized something that would change everything. I didn't have a strategy problem. I had a psychology problem disguised as a strategy problem. See, I thought I was trading supply and demand zones. I thought I understood candlestick patterns. But the truth was, I was just gambling with fancy terminology. I would see a hammer candlestick at what looked like support and immediately jump in with my entire risk allocation. No confirmation. No context. No patience. Just pure, desperate hope that this trade would be the one that turned everything around. The prop firm world is brutal. They give you capital, sure, but they also give you rules. Strict drawdown limits. Daily loss limits. Profit targets that seem impossible when you're bleeding money. And here's the thing that most traders don't understand until it's too late. These rules aren't designed to restrict you. They're designed to save you from yourself. After blowing up my 3rd account, I took a 2-week break. No charts. No trading Discord servers. No YouTube videos promising the Holy Grail. I just sat with a notebook and asked myself one question. What do consistently profitable traders actually do differently? Not what they say they do. What they actually do. That's when I discovered the truth about supply and demand zones. These aren't just random areas where price bounced before. They're institutional footprints. They're zones where big money entered the market with such force that it created an imbalance, and that imbalance wants to be filled. But here's the critical part that changed everything for me. Not all zones are created equal. I started studying my losing trades with brutal honesty. Every single one had a pattern. I was trading zones that looked good in isolation, but were terrible in context. I was ignoring the higher timeframe story. I was entering on the first touch of a zone instead of waiting for confirmation. And worst of all, I was letting my emotions dictate my position sizing. The psychological breakthrough came when I realized that trading isn't about being right. It's about being consistently wrong in small ways and occasionally right in big ways. That mindset shift, from needing to win every trade to accepting losses as business expenses, was the foundation everything else was built on. I rebuilt my approach from scratch. Supply and demand zones became my map. Candlestick patterns became my confirmation. But more importantly, I developed a set of psychological rules that were non-negotiable. Rule number 1, never enter a trade when emotionally compromised. Rule number 2, position size based on zone quality, not account size. Rule number 3, if I can't explain why I'm taking a trade in one sentence, I don't take it. The $15,000 prop firm account was my 4th attempt. But this time, something was different. I wasn't trading to prove anything. I wasn't trading to get rich quick. I was trading like a business owner managing risk and seeking asymmetric opportunities. The first month, I made $1,200. Nothing spectacular. But I didn't blow up. The second month, $2,800. Still grinding. By month 3, something clicked. I started seeing the market differently. Supply and demand zones weren't just lines on a chart anymore. They were stories about institutional behavior. A demand zone that held multiple times wasn't just support. It was a level where big money was willing to defend their positions aggressively. A supply zone that got tested and broke wasn't just resistance failing. It was a sign that the institutional narrative had shifted. And the candlestick patterns? They became my language for reading emotional extremes. A hammer at a demand zone wasn't just a reversal signal. It was a story about sellers exhausting themselves and buyers stepping in with conviction. A shooting star at a supply zone wasn't just bearish. It was a narrative about buyers getting trapped and sellers taking control. But here's what really separated this attempt from my previous failures. I stopped trying to catch every move. I became obsessively selective. Out of 100 potential setups I'd see in a week, I'd only take 3 or 4. And those 3 or 4 had to meet every single criterion on my checklist. No exceptions. No, this looks pretty good trades. Only this is exactly what I'm looking for trades. Let me break down exactly how I identify and trade supply and demand zones, because this is where most traders get it completely wrong. They think any level where price bounced is a valid zone. That's like saying any restaurant that serves food is worth eating at. The difference between a mediocre zone and a high-probability zone is everything. First, I only mark zones on the daily time frame and above. This immediately filters out 90% of the noise. Why? Because institutional money, the money that actually moves markets, operates on higher time frames. They're not scalping the 5-minute chart. They're building positions over days and weeks. When you align yourself with their time frame, you align yourself with the money flow. A valid demand zone for me has 3 characteristics. 1, it's created by a sharp, impulsive move away from the level. I'm talking about a move that covers significant ground in just a few candles. This tells me big money entered aggressively. 2, the zone hasn't been tested more than twice. Fresh zones have more potential energy. 3, there's a clear imbalance left behind, meaning price didn't slowly grind away from the level, it exploded. Supply zones are the mirror image. Sharp rejection, limited tests, clear imbalance above. But here's the nuance that took me months to understand. The best supply and demand zones are often found where you'd least expect them. Not at obvious support and resistance levels where everyone's watching, but at levels that make sense from an institutional perspective. Let me give you a real example from my trading journal. I identified a demand zone on euro to US dollar at 1.0850. This wasn't a level that had been tested multiple times. It was a zone where price had previously consolidated for 3 days before exploding upward by 200 pips in a single session. That consolidation was accumulation. That explosion was institutional buying. And when price came back to that zone 6 weeks later, I knew exactly what I was looking for. But I didn't just blindly buy when price touched 1.0850. This is where candlestick patterns become critical. I waited for confirmation. Price dipped into my zone, and I watched the candlestick formation carefully. The first candle was a long bearish candle that closed near the bottom of my zone. Weak hands would have panicked. I stayed patient. The second candle was a small-bodied doji, showing indecision. The third candle was a bullish engulfing pattern that completely swallowed the previous 2 candles. That bullish engulfing pattern told me a story. Sellers had pushed hard into the zone, probably triggering stop losses and creating fear. But buyers stepped in with such force that they not only absorbed all that selling pressure, they reversed it completely. That's not retail traders. That's institutional money defending their level. I entered on the close of that engulfing candle with a stop loss just below the zone at 1.0835. My target was the previous supply zone at 1.0950, giving me a 100 pip profit potential against a 15 pip risk. That's a 6.67 to 1 reward to risk ratio. The trade hit my target in 4 days, netting me $2,400 on a single position. But here's what separated this trade from my previous gambling. I had done the work before price even arrived. I had marked the zone weeks earlier. I had set alerts. I had written down my exact entry criteria. And when the setup appeared, I executed mechanically. No emotion. No second guessing. Just following the plan. The candlestick patterns I focus on are deliberately simple. Bullish and bearish engulfing patterns, hammers and shooting stars, and pin bars. That's it. I'm not looking for exotic three-candle formations with Japanese names. I'm looking for visual evidence of emotional extremes and institutional participation. A hammer at a demand zone tells me sellers pushed hard but got completely rejected. The long lower wick represents failed selling pressure. The small body near the top shows buyers regained control. But context is everything. A hammer in the middle of nowhere means nothing. A hammer at a high-probability demand zone with confluence from multiple time frames? That's a signal worth risking capital on. Here's my exact entry process, step by step. First, I identify my zone on the daily chart. Second, I wait for price to enter that zone. Third, I drop down to the 4-hour chart and wait for a candlestick confirmation pattern. Fourth, I check the 1-hour chart to ensure I'm not entering at a terrible micro level. Fifth, I place my entry order with a predetermined stop loss and take profit. Position sizing was another game changer. I risk exactly 1% of my account on every trade, but I adjust my position size based on zone quality. A pristine, untested zone with perfect confluence? I might take the full 1% risk. A zone that's been tested once before but still looks valid? Maybe 0.75%. A marginal zone that meets my criteria but doesn't excite me? I skip it entirely. This approach completely eliminated my revenge trading problem. When I lost a trade, I lost 1%. That's it. No emotional spiral. No doubling down to make it back. Just a simple business loss that I could easily recover with my next winner. And because my winners were averaging 4-to-1 to 8-to-1 reward-to-risk ratios, I only needed to be right 30% of the time to be profitable. The supply and demand strategy also taught me patience in a way nothing else could. Some weeks, I wouldn't take a single trade because no setups met my criteria. Old me would have forced trades out of boredom or fear of missing out. New me understood that capital preservation is more important than constant action. The market will always provide opportunities. Your capital won't regenerate if you blow it up chasing mediocre setups. I also developed a zone invalidation system. If price enters my zone and closes below it for demand or above it for supply, without showing any rejection, the zone is dead. I don't try to rationalize why it should still work. I don't wait for one more test. I simply remove it from my chart and move on. This single rule saved me from countless losing trades where I would have previously held and hoped. The strategy was important, but the psychological transformation was everything. You can have the best strategy in the world, but if your mind isn't right, you'll find ways to sabotage yourself. I learned this the hard way, over and over again. My biggest psychological enemy was revenge trading. After a loss, I would feel this overwhelming urge to get my money back immediately. It's like a gambler on a losing streak who convinces themselves the next hand will turn everything around. I would abandon my rules, lower my standards, and take trades that didn't meet my criteria just because I was emotionally compromised. The breakthrough came when I started treating losses differently. Instead of seeing a losing trade as a failure, I reframed it as tuition paid to the market. Every loss taught me something, either about the market or about myself. Did I enter too early? Was my zone selection flawed? Did I ignore a warning sign? Or was it simply a valid setup that didn't work out this time? I created a post-trade journal where I documented not just the technical aspects of each trade, but my emotional state. Before entering, I'd rate my confidence level from 1 to 10. After exiting, I'd rate my emotional control during the trade. This simple practice revealed patterns I never would have noticed otherwise. For example, I discovered that I traded significantly worse on Monday mornings. Why? Because I spent the weekend watching trading content on YouTube, getting hyped up, and feeling pressure to make something happen as soon as the markets opened. Once I identified this pattern, I implemented a rule: no trading on Monday mornings. I'd watch the markets, take notes, but not enter positions until Monday afternoon at the earliest. Another psychological shift was learning to love small wins. In my early days, I would hit a profit target and immediately feel disappointed that I hadn't held for more. I'd see price continue in my direction after I exited and beat myself up for leaving money on the table. This mindset was toxic because it meant I was never satisfied, even when I won. I started celebrating every winning trade, regardless of size. A 1% gain? Excellent. A 3% gain? Outstanding. A 6% gain? Exceptional. This positive reinforcement trained my brain to associate trading with success rather than constant dissatisfaction. And paradoxically, once I stopped trying to squeeze every pip out of every move, my overall profitability increased because I was taking profits consistently instead of watching winners turn into losers. Fear of missing out was another demon I had to conquer. I'd see other traders posting screenshots of massive wins on social media, and I'd feel this anxiety that I was missing opportunities. This would push me to take marginal setups just to be in the game. The reality? Most of those social media posts were either cherry-picked winners or outright fabrications. I unfollowed every trading account that made me feel inadequate or rushed. I stopped checking trading Discord servers during market hours. I created a bubble where the only thing that mattered was my plan and my execution. This dramatically reduced my stress levels and improved my decision-making. The concept of cutting losses quickly took on new meaning for me. It's not just about having a stop loss. Everyone knows that. It's about accepting when you're wrong without ego. Some of my best trading days were when I took 3 small losses in a row and then stopped trading because I recognized the market wasn't behaving as expected. Old me would have forced more trades, trying to make back those losses. New me understood that preservation mode is a valid trading state. Managing winning streaks was just as challenging as managing losses. After 3 or 4 consecutive winners, I'd start feeling invincible. I'd increase my risk, lower my standards, and take trades I normally wouldn't touch. This overconfidence destroyed more accounts than losing streaks ever did. I implemented a circuit breaker system. After 3 consecutive wins, I'd take a mandatory 24-hour break. This forced me to reset emotionally and prevented the euphoria from clouding my judgment. Similarly, after 2 consecutive losses, I'd reduce my risk to 0.5% for the next 3 trades. These rules felt restrictive at first, but they saved my account multiple times. The most profound psychological shift was accepting that I couldn't control outcomes, only process. I couldn't control whether any individual trade would win or lose. I couldn't control sudden news events or flash crashes. But I could control my preparation, my execution, and my response to results. This shift from outcome-focused to process-focused thinking eliminated 90% of my trading anxiety. I also developed pre-trading rituals that put me in the right mental state. Every morning before looking at charts, I'd spend 10 minutes reviewing my trading rules. I'd visualize myself executing trades with discipline. I'd remind myself that my goal wasn't to get rich today. It was to execute my plan flawlessly regardless of results. One technique that dramatically improved my emotional control was the pause button practice. Whenever I felt a strong emotional reaction, whether excitement about a potential setup or frustration about a loss, I'd literally stand up, walk away from my computer, and take 10 deep breaths. This simple physical break interrupted the emotional loop and allowed rational thinking to return. Month 4 was when everything clicked. I had built enough trust in my system that I could execute without hesitation. My win rate was sitting around 35%, but my average winner was 5.2 times larger than my average loser. The math was working beautifully. I remember the trade that changed my trajectory. Gold had been in a strong uptrend, and I identified a demand zone at $1,920, where price had previously consolidated for a week before exploding upward. Price pulled back into that zone during a period of general market fear. Everyone was talking about recession. Sentiment was bearish. Perfect. I waited for my confirmation. A hammer formed on the daily chart, followed by a bullish engulfing pattern on the 4-hour chart. I entered with a stop loss at $1,912 and a target at $1,965. The risk was $8 per ounce, and the reward was $45 per ounce, a 5.6 to 1 ratio. I sized the position to risk exactly 1% of my account. The trade took 11 days to play out, but it hit my target perfectly. That single trade netted me $4,800 and pushed my account over $30,000. But more importantly, it reinforced that my system worked even in challenging market conditions. I didn't need perfect conditions. I just needed to wait for my setup and execute with discipline. Scaling the account from $30,000 to $100,000 required a different mindset. The temptation was to increase risk now that I had house money to play with. But I recognized this trap. Every dollar in my account was real money, whether it came from my initial deposit or profits. I maintained my 1% risk rule religiously. What I did change was my opportunity selection. With a larger account, I could afford to be even more selective. I started focusing exclusively on the absolute best setups, zones that had never been tested, with perfect candlestick confirmation, on instruments with strong trending characteristics. My trade frequency dropped from 8 to 10 trades per month to 4 to 6 trades per month. This hyperselectivity paid off massively. My win rate actually increased to 42% because I was only taking the cream of the crop. And my average reward-to-risk ratio improved to 6.3 to 1 because I was targeting larger moves with more conviction. I also started compounding more aggressively. Instead of withdrawing profits, I let them accumulate in the account. This meant my 1% risk was growing in absolute dollar terms even though the percentage stayed the same. A 1% risk on a $30,000 account is $300. On a $60,000 account, it's $600. Same risk percentage, double the profit potential. The psychological challenge of managing a larger account was real. Losing $800 on a trade felt different than losing $200, even though both represented the same percentage loss. I had to constantly remind myself that percentages matter, not absolute dollars. A 1% loss is a 1% loss whether it's $100 or $1,000. I developed a new ritual for large accounts. I stopped looking at my account balance daily. Instead, I focused purely on execution quality. Did I follow my rules? Did I wait for proper confirmation? Did I manage the trade according to plan? If the answer was yes to all three questions, I considered it a successful trading day regardless of monetary results. Month 7 brought my biggest winner. Euro to US dollar had formed a demand zone at 1.0650 after a sharp sell-off. The zone was pristine, created by a massive institutional buying surge that moved price 300 pips in 2 days. When price returned to that level, I got my confirmation, a pin bar on the daily chart with a massive lower wick. I entered with a stop at 1.0635 and a target at 1.0850. The reward to risk was 13.3:1. It was the best setup I'd seen in months, so I took the full 1% risk. The trade took 3 weeks to play out, testing my patience multiple times. There were days when it looked like it might stop out, but I trusted my analysis and let the trade breathe. When it finally hit my target, I netted $11,400 on that single position. My account crossed $85,000. I was within striking distance of my goal. Looking back at the journey from $15,000 to over $100,000, the lessons are crystal clear. The strategy matters, but psychology matters more. Discipline beats intelligence. Patience beats aggression. And consistency beats brilliance. If I could go back and tell my earlier self 3 things, here's what they would be. First, stop trying to trade like everyone else. The market rewards unique thinking, not herd mentality. When I started ignoring what everyone else was doing and focused solely on what made sense to me, my results transformed overnight. Second, your edge isn't in your strategy. It's in your ability to execute that strategy flawlessly under pressure. I've met traders with mediocre strategies who make consistent money because they execute with robotic discipline. And I've met traders with brilliant strategies who lose money because they can't control their emotions. The difference is always psychology. Third, the market doesn't care about your bills, your dreams, or your desperation. It will take everything from you if you let it. The only way to survive is to trade without emotional attachment to outcomes. Every trade is just one in a series of thousands you'll take over your career. No single trade matters. Only the process matters. Here's what I want you to understand about supply and demand trading. It's not a holy grail. There will be losing trades. There will be frustrating periods where nothing sets up. There will be times when you question everything. But if you commit to the process, if you focus on high probability zones, if you wait for proper candlestick confirmation, And if you manage your psychology ruthlessly, the math works in your favor. The beauty of this approach is its simplicity. You don't need expensive software. You don't need insider information. You don't need to watch charts 24 hours a day. You just need to identify quality zones, wait for confirmation, and execute with discipline. That's it. Everything else is noise. My typical week now looks nothing like my early days. I spend maybe 10 hours total looking at charts. I mark my zones on Sunday evening. I set alerts. Then I go live my life. When an alert triggers, I check if my confirmation criteria are met. If yes, I execute. If no, I wait. No stress. No anxiety. No compulsive chart checking. The prop firm model was perfect for this journey because it forced me to develop proper risk management. Those drawdown limits that felt restrictive, they saved me from myself countless times. The profit targets that seemed impossible, they gave me clear milestones to work toward. If you're serious about trading, I can't recommend the prop firm route enough. Now, let me address the elephant in the room. Can you replicate these results? Honestly, maybe. It depends entirely on your willingness to do the psychological work. The strategy I've shared is simple. Anyone can learn to identify supply and demand zones. Anyone can recognize a bullish engulfing pattern. But can you sit on your hands for 2 weeks waiting for the perfect setup? Can you take a loss without revenge trading? Can you let winners run without prematurely taking profits? That's where most traders fail. Not because they lack intelligence or education, but because they lack emotional control. If you take nothing else from this video, understand this. Trading success is 90% psychology and 10% strategy. Master your mind, and the money follows. Here's your action plan if you want to follow this path. Step 1. Spend the next 2 weeks just marking supply and demand zones on the daily chart. Don't trade. Just observe. Learn to recognize what quality zones look like. Study how price reacts when it returns to these levels. Step 2. Add candlestick pattern recognition to your skill set. Focus on the big 3: engulfing patterns, hammers and shooting stars, and pin bars. Learn to read the story they're telling about buyer and seller dynamics. Step 3. Paper trade for at least 1 month. Execute your strategy in a demo environment. Track every trade. Journal your emotions. Identify your psychological weak points. This is where you'll discover if you have the discipline to succeed. Step 4. Start small with real money. I don't care if it's a $1,000 account or a $10,000 account. Risk 1% per trade. Build your confidence. Prove to yourself that the system works. Only then should you consider scaling up or pursuing a prop firm account. The prop firm I used and still recommend is linked in the description below. They have reasonable evaluation criteria, they actually pay out, and their support team is responsive. I just genuinely believe they're one of the best options for serious traders. Check them out if you're ready to take this seriously. Before we wrap up, I want to address something important. This journey took me 8 months of focused effort after 3 previous failures. That's almost 2 years of total learning time if you count the blown accounts. This isn't a get-rich-quick scheme. It's a legitimate skill that requires time, effort, and emotional maturity to develop. But here's what makes it worth it. Once you develop this skill, it's yours forever. The market will always provide opportunities. Supply and demand zones will always exist. Institutional money will always leave footprints. You're not learning some temporary hack that stops working. You're learning to read market structure at a fundamental level. The freedom that comes with profitable trading is indescribable. I'm not talking about buying lumbos or flexing on Instagram. I'm talking about the freedom to work from anywhere, to control your own schedule, to not answer to a boss. That's the real prize. My account sits at $127,000 as of this recording. I've withdrawn $40,000 in profits over the past 3 months while continuing to grow the account. This isn't luck. It's not a fluke. It's the result of a repeatable system executed with discipline. Your turn. If you found value in this breakdown, smash that like button right now. Subscribe to this channel because I'll be sharing more detailed trade breakdowns, psychology lessons, and real-time analysis. Comment below with your biggest takeaway from this video. I read every single comment, and I'll respond to as many as I can. And remember, The market doesn't reward complexity. It rewards clarity, patience, and discipline. Master those three things, and you'll be unstoppable. Now go mark some zones. Wait for your setup. Execute with discipline. And I'll see you in the next video where we'll break down specific trade examples from my journal. Let's get it.